Assalamu alaikum, friends. Welcome to Phookpeer Cypher. Today we're exploring harmonic patterns in trading. If you want to understand the market and spot high-probability trades, this is for you. Harmonic patterns are special price formations that use Fibonacci ratios to predict potential reversal points in the market. Unlike regular patterns, they are mathematical and precise, helping traders identify entry points, stop losses, and targets with clarity. These patterns are formed by a series of price swings marked as X, A, B, C, and D. It starts with the initial move XA, followed by a retracement called AB, then a corrective leg BC, and finally the CD leg, which completes the pattern. The D point is the most important. It's the zone where the price is likely to reverse, and traders look for confirmations before entering a trade. Harmonic patterns follow strict Fibonacci rules. AB retracement usually moves 38.2% to 61.8% of XA. BC retracement can be 38.2% to 88.6% of AB. CD extension typically stretches 127% to 161.8% of BC. Each pattern, like Gartley, bat, butterfly, or cipher, has its own specific ratios, making them precise tools for trading reversals. Mastering harmonic patterns can give you a clear and structured approach to trading the market with confidence. I am Phookpeer Cypher, guiding you to understand the market with precision. Stay tuned for more videos where we break down each pattern with